Maneco 64, home of alternative economics and contrarian views. Well, tomorrow, Tuesday, April 8th, I'm playing golf in the morning. So this video is being recorded on Monday afternoon London time, but it's coming out on Tuesday. And I want to talk about the Secretary of the Treasury, Scott Bessent. He recently did an hour interview with Tucker Carlson, where he basically laid out his cards on the table for the whole world to see. And I think that was a big mistake. And what I want to talk about, right now is the fact that I think Bessent's Gambit is backfiring monumentally. And what is, well, first of all, let's look at the definition of Gambit, and then I'll tell you what I think Bessent's Gambit is. So in chess, it's an opening move in which a player makes a sacrifice, typically of a pawn, for the sake of compensating advantage. So Scott Bessent basically laid out his cards, as I said, to the whole world through the Tucker Carlson interview. And he said that the most important indicator for him is the 10-year treasury yield, the bond market. And I know a lot about the bond market because I was a government bond broker for over 20 years. But he said that he wants the 10-year yield below 5%. He said that's a very important level for him. And he said that during the confirmation hearing and when he was confirmed around January 28th, the 10-year yield had gone up to almost 5%. It was at 480 and he was concerned. And so what is the Gambit? What do I think Bessent and Trump are sacrificing for the sake of bringing the treasury yield down? And it's really important for them to bring that yield down because the treasury has about $9 trillion to refinance in maturing securities this fiscal year. Well, the Gambit is that they're using this hammer with the tariffs and everything else to bring down the stock market. Because usually when the stock market has a big correction, treasury yields drop. People go to the safety of treasuries. But that seems to be backfiring. And I spoke about this on Saturday, April 5th, because I noticed that on Friday, April 4th, despite the fact that the stock market finished massively down and near the lows of the day, the 10-year yield rallied from 386 to 4%. I'm going to put that video I made on Saturday, up here. It's entitled 10-year treasury yields spiked ominously higher as stocks crashed at the close. So as I speak here, it's 4:30 p.m. London, so just before midday Eastern time in the US. And we've got the Dow down about 1,000 points, S&P down about 108 points, and the NASDAQ 100 about 300 points. And it's been very volatile, mainly because we're starting to see Wall Street kind of panic. We saw over the weekend that Bill Ackman, one of the big hedge fund managers, said that Trump should call for a 90-day pause to negotiate with the world vis-a-vis the tariffs. We saw that Jamie Dimon, the CEO of JP Morgan, said that this needs to be sorted out quickly because it could hurt not just the US, but the whole world's financial system. And both of these guys are still very supportive of the Trump administration. And one of the reasons why I think this gambit could backfire and fail miserably is because the 10-year yield, despite the fact that I just told you that the Dow was down 1,000 points, the 10-year yield right now is at 4.1%, up about 11 basis points on the day, and that's not normal. It should be right by now. We should be at 3.5%, considering where we were Friday morning. So what's going on here? Could the bond vigilantes or Wall Street be forcing Bessent's hand? Of course they could. They know what Bessent showed all his cards to the world, as I said earlier. Or we could have not just bond vigilantes, we could have foreign actors. And why do I say that? Well, because the Chinese are upset about what's going on. And earlier today, we had some kind of fake news that said that the White House had paused the tariffs, was thinking about pausing the tariffs for 90 days. The markets rallied massively. The 10-year yield actually went to 425. But it's been denied, of course, so it doesn't look like there's going to be a pause. And I just want to read to you what Luke Roman posted today on X about what's going on with the 10-year yield. He said, since late February, a 19% decline on the S&P 500 or SPX drove a 19 basis point decline on US 10-year treasury yield. And that's minuscule. That's a drop like in the ocean. I would have said Bessent would be looking more for like a 50 to 75 basis points drop in yields. And Groman goes on to say, a very good analogy, I thought. This is like pissing in your pants to warm up in sub-zero weather. Feels great for a little bit, but in a few hours you're dying of hypothermia. And he says, must devalue debt to GDP first, or else it's a root canal with a shotgun. So, yeah, I think, Scott Bessent and the Treasury and the Trump administration is in trouble. I think volatility is going to continue to play a part. I mean, the markets have been all over the place. And having worked in the markets for over 20 years, traded for clients, I don't recommend any day trading in such an environment. What have I been doing? Well, yesterday was the first day of the tax year here in the UK. So I can put some more money to work in my tax-free ISA account. That's what I did earlier today. Not that much, but I bought some silver mining shares. I can tell you which stock it is. I have others, but I'll tell you what this one is. It's ASM, the ticker symbol, Avino Silver and Gold Mines Limited. This is not advice. I'm just telling you what I'm doing. Of course, I still see a base of physical gold and silver as the most important thing. My miners are just speculation. More, it's like being leveraged without being leveraged, so to speak, and it's a proportion of my savings that I'm comfortable with risking. And I'm not here to tell you exactly what you should do, but you need to think of your circumstances and decide how much risk you want to take. So as I speak here, even gold and silver have come off a little bit now, despite the fact that silver is still up about 1%. And of course, I'm talking on Monday, midday, New York time here. We're just around 30 on the spot price. Gold from Sunday to Monday overnight had dropped to 29.70. earlier in the day today, we were comfortably above 3,000. Right now, we're at 2984. Am I concerned? No, not one bit. I still think it's very important. The only things monetarily, in my opinion, right now that have a track record of surviving crises through the millennia are gold and silver. And I think things are so uncertain right now that if you don't have any gold and silver, you could be in trouble. Or, yeah, I don't think you will sleep as soundly at night. So that's the way I continue to see it. Yeah, and as I speak here, as I said, the stock market is down about 2% across the board. And the problem now for the Trump administration, I think, is the bond market. It looks like the bond vigilantes or Wall Street are clamoring for a rate cut from the Fed, an emergency rate cut. And they're at the same time trying to force the administration to pause these tariffs for 90 days. And it's interesting that the fake news that came out said that they were considering a pause, but that the only country that wouldn't be included would be China. I mean, that would be very provocative, I think, and it might actually backfire even more, even though it's fake news. And why would it backfire if they did something like that? Well, because China, they hold, I think, 700 billion worth of treasuries, and they could do a lot of damage to that market. That's the way I see it. So I think you should keep an eye on the treasury market. I'm going to put a link below in the description to where you can keep track of the 10-year yield. And I would also add that the 30-year yield, the bond yield, the 30-year bond yield, that's up 15 basis points today at 4.55. That's not helpful either. And yeah, keep track of that. And if you continue to see the stock market go south and long-term yields continue to go up, yeah, that's trouble ahead. And with that, I want to wish you all a very good day. Take care. Bye.